To our talk of the tape, whether the bears are suddenly sweating as stocks stay resilient and the VIX drops again. Well, let's ask one. Greg Branch of Veritas Financial Group is back with us today. I don't know. I can't see the picture very well. Are you sweating? Because you are a bear, and this market's been getting away from you, hasn't it?
It has, Scott, but I am sweating no more than I was sweating in August of 2022, and it seems a lot like August of 2022. Shall I count the ways?
Well, I mean, you don't have to go through all of them, but surely you had to have looked at this market and wondered to yourself, am I wrong? In fact, do the bulls now have control based on the way things have been trading, honestly?
Yeah, look, and I think we ask ourselves that question every day, Scott. So the question is there whether the market's going towards my prediction or not. But I think it is important to count the ways. So I'm going to do that. But just like in August, we have kind of this erroneous policy expectation that we've had to fight. Then it was talk of a pivot. Now it was the market looking for interest rate cuts in the back half, which for 6 months I have been incredulous about, as not seeing that as a possibility. We fought the notion that the market was cheap back in August, that it was 17 times. And just as then, the estimates are wrong. So no, the market's not trading at 17 times. The market's likely trading at 20 times forward. And then as now, and we're all built this way, we're all human beings, we all want the market to go up. But, when these things are powered by emotion and not the substantive data that we're receiving, it's hard for me to envision this as having any legs as the narrow breadth indicates.
But Greg, your view sounds to me like the one that's potentially being powered by emotion, not by where the market has actually gone, right? You've been negative for some time. The market's been going in the opposite direction.
Right.
The economy's been, I think it's fair to say, more resilient than most have expected it to be. I think earnings have remained more resilient than most have expected them to be. And I think AI is potentially a bigger earnings dryer than almost anyone expected it to be, because we weren't even having this conversation back in August of 2022.
And I concede everything you're saying, Scott. The problem is in the first two things you said. The economy has proven to be more resilient than we thought it would be. Admittedly, we had a stronger than expected first quarter. We're likely to have a stronger than consensus second quarter, but we have to examine why that is. And I think part of that was the Fed spending down $700 billion of untaxed and unborrowed money, which was a shot of adrenaline. And so it doesn't really, that's not what plays into our forecast. What's going to happen is more important to our forecast. And right now, consensus took the opportunity on an unexpectedly strong first quarter to raise estimates, when likely what we should be doing is looking at that third quarter with 2% growth and 9% in the fourth quarter, and starting to decrease those estimates. And I do believe that we'll see significant downward earnings revisions. I do believe that the Fed have to do one of two things. They either have to raise rates, or they have to abandon the search or the quest for 2% inflation. There is no third possibility, and you can't have both.
Yes, there is. There is. That they don't raise in June, which seems like that's the likely scenario. And they don't have to raise nearly as high as you still think they'll go, because inflation actually is coming down faster than you want to admit or are willing to say. I want to read you something that Barron said today. Okay, because I want your reaction to it before we open this up. Quote, investors are positioned for the worst. The only problem, they may be positioned for a bear market that already occurred. And the higher the S&P goes, the more likely it is that bearish investors will have to start buying. Are you one of them?
I'm not. And it does acknowledge something that I will also acknowledge, right? We are sitting on historically high cash positions. B of A's investment management survey had fund managers at near peak 6%, which is usually around 4% cash. Accredited investors are sitting around 35% cash or cash equivalent in their portfolios. So I get how that could be construed as the powder for a continued bull market, but I think it's going to be more of a trend, Scott. And just to dispel some myths here, I am exactly 1 point above where we are right now. I set a terminal rate of 6.25% projection. We're at 5.25, so I'm not nearly as draconian as you make me out to be, my friend.
I mean, another full point to many would sound like it's draconian. You wanted to go another 100 basis points. I mean,
I don't want it. I just think it will.
I don't know. Maybe I don't know why the Fed Now, maybe they will be forced to. Nobody has a crystal ball, and I can't say that they're not going to do that. But I would say it seems more unlikely than not, just given where we currently are, that they're going to have to go that high on the terminal rate, Greg.
I'll take the other side of that, Scott. And I think those 339,000 jobs we saw last month has something to say about it as well. Well, we're sitting at historically low unemployment. While we're sitting at historically low claims, that is not a good sign for us coming closer to the Fed's 2% target. And so, look, you win, and all those things will be true if the Fed says 2% is no longer important. But we're simply not going to get there with the wage inflation and the jobs creation that we see going on now. That's going to continue to power inflation.
Now, I'm looking at the major averages right now, so you'll forgive me for looking away from you. Dow Jones Industrial Average is the highs of the day. It's up 182 and climbing as we speak. And the S&P 500 may very well hit 4,300 by the time we're finished with this show today. We have about 54 minutes to go. You are unmoved by the resiliency of this market, by the technical hurdles that this market has gotten over, to the point where you still think we're going back to the October lows, because the further you get away from that, the less likely it is that we're going back to that.
That's what the math says to me, Scott. I do want to differentiate between things that I want and things that I see. And you keep typifying this as something that I want. I, like everyone else, wants the market to go up.
Yeah, but you want to be right, too. Everybody wants to be right in their calls, Greg.
I've been right. I'm not going to be right all the time. I don't expect to be right all the time. And so, no, my view isn't powered by that. If the Fed comes out and says that 2% is no longer important, then I'm happy to become bullish. But as long as that's the case, and as long as we see unemployment where it is, and as long as we see wage growth where it is, then I have to stick to this reality.